Okay, so I'd like to introduce you to the next panel is our small business term lending panel. I'm going to hand it over to our moderator, Jacob Ha. He's the co-founder and managing partner of Community Investment Management, which is a firm that's focused on small business investing. So over to you, Jacob.
Great, thank you, Peter. It's great to see the growth in the industry and of LendIt since the inaugural conference last year, and we owe a debt of gratitude to Peter, Dara, Bo, Jason, and the team for putting it all together. So thank you very much. We have a great panel for you today. Peter mentioned this morning how one of the more recent innovations in the online direct lending space is the term loan small business product. And that's a welcome innovation, as it was significantly lacking from the marketplace. And small businesses really are the drivers of our economy and critically lack access to financing at the current moment. There are 28 million small businesses in the United States, 6 million of which have one or more employee. Just to put the role of small businesses in context in the United States, according to the US Government Small Business Administration, small businesses account for 99.7% of US employer firms, 64% of new private sector jobs, 49% of private sector employment, 43% of private sector payroll, 46% of private sector output, 43% of high-tech employment. They account for a third of the US exporting value and make up 98% of the firms that export those goods and services. By way of background, my partners and I have been investing in micro and small business lenders in emerging markets for the greater part of the last 10 years. And similar to emerging markets, small businesses in the United States today are lacking productive capital for them to expand, as banks have withdrawn from that market, arguably in a 20 to 25-year trend, and particularly over the last 7 years since the financial crisis. What's filled that gap, as Peter mentioned also, in the last few years, we've seen the growth of alternative financial service providers, which have provided short-term, low balance, and often high cost into triple-digit interest rate forms of funding. And the panelists that we have here today are the innovators who are bringing products to market to fill that gap. That's a gap that's been estimated to be between 150 to 400 billion. Some estimates I've seen are even higher. And with that, I'd like to welcome our panelists for a lively discussion today. I'm very grateful for you all to be here. And kick it off with our first question. And I think starting with Sam, and then coming to Gary, closest to me, if you could just give us a very short introduction, briefly describe who the borrowers are that your platform is focused on, and what you believe your addressable market within the next 2 to 3 years is.
Sure thing. So I'm Sam Hodges. I'm the co-founder and head of Funding Circle in the US. Funding Circle is the world's leading marketplace for small business credit and the first one to be doing this internationally. This year are on track to do about $600 million in origination, focused exclusively on small business loans between $25,000 up to about $1.5 million. The loan that we're providing is really meant to be a substitute for what banks used to do in the space. So the ability to finance at a reasonable rate things like equipment purchases, building out a new location, purchasing a business, and I would say our prototypical borrower is probably doing, call it anywhere between $500,000 and a couple $1 million in revenue, looking for capital to really expand and grow. One nice stat is after a Funding Circle borrower takes out one of our loans, typically they hire anywhere between 3 and 4 additional people within 6 months.
Tom Green from Lending Club. I'm responsible for new products at the company. As you know, Lending Club is the nation's leading online credit marketplace, and we launched a small business program around about 6 weeks ago with rates starting at 5.9%. We are focusing on creditworthy businesses that have been under current ownership for at least 2 years, but who are frustrated by the existing set of options, or frankly lack of options in the marketplace today. So we offer a very easy online application process with low rates starting at 5.9%. In terms of the size of the market, as you know, there are roughly 27 to 28 million small businesses in the US. Many of those would like more access to capital but cannot get it. Roughly 2/3 of those who try to get access to capital fail to do so. And so we're focused on really addressing that underserved market. In terms of the size, it's clearly in the hundreds of billions, and we can obviously debate the exact amount, but it's a very large underserved market.
Noah Breslow, I'm the CEO of On Deck. We're the leading online direct lender to small businesses here in the US. We've done over $1 billion using a non-FICO based approach we call the On Deck score to provide capital to all kinds of businesses, whether it's restaurants or retailers or healthcare providers, service businesses, manufacturers. We made our first loan back in 2007, so we got to survive the exciting journey of 2008, 2009. Company's been growing very rapidly. We grew about 150% from a revenue standpoint last year. Our Q1 originations were about 180% over where they were a year ago. We recently completed the first securitization of non-SBA business loans in the space, so we're very excited about that transaction. Our typical customer has, believe it or not, been in business nearly 10 years. So kind of shocking that such established businesses would have trouble accessing capital from traditional players. So we really see a huge market opportunity, just like the other panelists. It's hundreds of billions of annual origination volume, millions of end users who we think can benefit from the product. And one of the things we compete on is speed and convenience. So we can approve a $35,000 loan online in minutes with no human touch. We can do a $250,000 loan in several hours and turn that funding around the next day. So we think that's a big part of the value proposition for this segment.
Hi everyone, my name is Ethan Centurio. I'm the CEO of DealStruck. We are a peer-to-business lending platform focusing on loans in the $50,000 to $250,000 range. We offer multiple products, both term loans, which we're talking about today, but also revolving lines of credit, which is something that the market also needs quite a lot. We are typically working with borrowers looking to graduate from some of the lower sized, higher cost, shorter term products on the lower end of the market up to what would be conventional bank or credit union relationships. So these are companies that are all growing, they all have longevity, they all have relatively substantial sales, and either have been discouraged and opted out of the capital markets for small businesses for some period of time, or are not able to get the financing they need from either banks or the typical alternatives out there.
Gary Chode, CEO of RaiseWorks. We're a New York-based peer-to-peer lender focused on the small business market. Similar size to what some of the other panelists discussed, 25 to 250,000 in loan size, focused on the term market as opposed to the short-term market. In terms of size, it's obviously very, very large. I think as we look at it, probably 370 billion of total addressable market, of which what we'll call mid-prime, which would be individuals with, let's say, FICO scores between 640 and 710, if you were going to equate it to a FICO score, would be about half, and then the other half being roughly evenly distributed between prime and subprime. Beyond prime would be the super prime, which really would be more like the bank market.
Great, thanks. But I think just as a follow-up, I mean, clearly the market is large, 200 billion, 400 billion, plus 370 billion. But sitting here with some of the leaders in this space, in the term loan market, we have less than 500 million in outstanding portfolio. So I would wonder, yes, there's a giant market. What actually can investors expect, and what can we expect to achieve within the next 2 to 3 years within this type of customer acquisition framework and trying to build these businesses?
I don't think it's unrealistic to see exactly what you've seen happen in consumer happen in small business, where within the course of a 3 or 4 year cycle, you're seeing multiple billions of dollars a year going through these types of platforms. I mean, some of the folks up here are already, have already hit some of those milestones on a direct lending model, and we're all getting there on a peer-to-business model. But fundamentally, it's an awareness thing. It's about businesses knowing that you can get $250,000 or $500,000 online, and it's not your place of last resort. And that really just comes with continuing to press on the market and let people know that it's realistic. But I don't see any reason why it can't have the same trajectory.
I very much agree with Ethan's point. I mean, banks have structurally pulled out of sub-$1 million term loans to small business, and when we think about what are the dynamics that are shaping our business, it's not competition, it's not lack of addressable market, it is purely awareness and borrower acquisition. And so we think it is very feasible in the United States to build a multi-billion-dollar origination business on an annualized basis quickly over the next couple of years.
I mean, for Lending Club, I think we've learned to scale a business. We've done over $4 billion in originations to date, and this being a major new product line for us, we have big ambitions for it as well. We think it can be another large product line for us. Clearly, to get to that 200, 400 billion stage is going to take some time, but I think the fundamental structural cost disadvantages that the banks have and that have been talked about in other sessions already today mean that this will be the predominant model for small business lending eventually.
I mean, one other quick thing, like a lot of the businesses up here, even 7 years old, is quite young in the scheme of financial services. And so, although there may be huge market to go take, there's a limit to how quickly you can go tackle it without doing it poorly, which of course would impact all the investors, deploying capital into those loans. So I think part of it is some restraint on the folks up here making sure to get into the market intelligently, and that will scale up over time as the data accrues as we go through cycles and things like that.
Yeah, no, I mean, just to second what Ethan's saying, it's not only the ability to scale up originations, but then from the investor perspective, you have to wait for those vintages to complete and see how they actually perform, right? So I think that one of the reasons that the short-term market in business lending evolved a little bit before the long-term market did is because of that exact issue. You can see vintages complete much faster. I mean, OnDeck's been around now for 7 years. We've got essentially 28, I guess, quarterly static pools that have now run a lot of them to their final state. And that gave us the confidence to then start to move into larger loans and longer terms on the basis of that performance history.
Great. Well, I think that leads into the next question, which I had was really focusing on, Noah, last year at LendIt, you mentioned that OnDeck was able to weather the financial crisis that went through and changing credit environment because of the short-term nature of your product and because of the flexibility. And now that you're up here with this longer-term product and you're surrounded by 4 other companies that also are going into this space, I'd like to hear how you're structuring the product. I'd say maybe first to Noah, and then we can open it up. How you're structuring the product to really tackle the additional risk of going longer term and anticipating weathering additional credit cycles.
Yeah, so no, it's a totally fair question, and I think still product structure and managing term appropriately are 2 of the most important tools we have available to us as lenders. The best credit models are a big part of it as well, but we came out with a product called Term 24 a couple months ago. It's our first foray into kind of the 2-year time span. We had at the time last year been out to 18 months. We're still not going down to the single-digit APRs on that product. So I would argue that we still have a fair amount of structural protection, not only in the rate we're charging, but we're still doing our sub-monthly, either daily or weekly collection on that product. So that's another way that we structurally protect our investors in that product. And you don't see us going out to 3 years or 5 years in our duration. Our fundamental belief is that a 5-year loan to a business is almost a bet more on the business owner. And the idea behind the OnDeck score is really making a more focused bet on the performance of that actual business in a time frame that you can reasonably project forward that performance.
Great. Ethan?
Yeah, so I think when you move up market into the longer terms, but also part of going to a longer term is also moving into larger sizes, you start to see businesses that have different needs, right? So speed becomes perhaps less of priority for them when they're talking about a $250,000 loan than when a $50,000 or $35,000 loan. And so because that is a lower priority, you have the ability to be more flexible in terms of what you look at in your underwriting, how you structure the documentation and the actual transaction itself, which can make going out to a longer term more secure. And so as you balance what if the borrower is more focused on, I need a larger loan or I need a longer term, well, they're usually willing to sacrifice one of the other variables, sometimes that's speed, to be able to allow the lender to facilitate that transaction.
And just to add on to that, I mean, I think there's a really big difference between doing sub-18 or even sub-24 month and then multi-year term lending, simply because the return on capital envelope that a small business has isn't necessarily going to be able to support a really short amortization schedule and a teen or even much higher rate. The way we think about it is if we can actually price a secured term product within the return on capital envelope a typical small business owner can get, we actually avoid a lot of the adverse selection problem that some of the other shorter term lenders out there have already experienced.
I'll make a couple of points here. One of them is that there are different capital needs that small businesses have. Some of them are short-term needs, some of them are long-term needs. And if you want to serve the long-term needs well, you have to find the right ways to underwrite those businesses. Underwriting short-term needs tends to be more focused on the shorter-term cash flow performance of the business. If you know that you're going to be in and out in 6 or 12 months, then you can look at a different set of attributes and variables versus if you're doing a 3 or even a 5-year loan. And so some of the things we look at for some of these longer term loans are more fundamental underlying characteristics that enable us to understand the strength of the business and forecast its longevity better than we would need to if we were doing a shorter term product. The other thing I'll say is that we manage risk for these longer term products partly through only offering the longest term products to the best qualified businesses, and also through recognizing that there is a trade-off between the length of a loan and its risk, and therefore giving businesses, in some circumstances, giving businesses a higher rate if they're taking a longer term, which enables them to make a choice about whether they want a slightly lower payment or whether they want a shorter term. And this is an approach that we have a lot of experience. We have several years of experience managing these kind of trade-offs from our 3- and 5-year consumer loans.
And also, what about the use of technology in terms of how technology is able to assist with going longer term? I mean, is technology as useful if you're doing 5-year loans as it is if you're doing 6-month loans? Tom?
Absolutely, yeah. And so we use technology. One of the main ways we use technology, or one of the most value-added ways, is in integrating multiple data sources. So in small business lending, the heterogeneity of data that's out there on small businesses is far, far greater than in the consumer lending space. And so what we need to do is pull in data from numerous different sources and make the customer experience dynamic to the data that we're finding across those different sources. And some of these sources are able to predict more shorter-term behavior, others predict longer-term behavior better. And by integrating them in the right ways, we're able to use technology to not only make a good credit decision, but provide that decision instantly to the customer, which is, of course, what they want.
And just to add on to that, we also use technology around pulling in third-party data sources and making sure our credit model is evaluating the right things within a loan file. There really are 2 other major areas that I think are just as important in terms of use of technology. The first is really around borrower experience, making sure it's very fast, making sure that people are presented with the right questions, making sure that overall the experience is really seamless. That, again, helps get the best borrowers and avoid some of the adverse selection that if you're kind of a smaller lender who has a more uneven experience, you might have. The other piece of it really is in the workflow tools we provide for commercial underwriters. I think one of the biggest differences about the funding circle model is we have 2 technology-driven steps in underwriting, but then every single loan that we end up placing on the marketplace goes to a commercial underwriter, someone who's really experienced at looking at files, rigorously analyzing them, and it's only at that step would they eventually get funded. And we can work a file through our commercial underwriters in a very streamlined way because of the technology systems we have on the back end.
And I think the one piece that hasn't been spoken about yet is how technology can enable servicing. So as we talked about, as you're going out to larger loan sizes and longer terms, you now have an asset on your books for longer that you have to get more payments from, and you have more volatility risk associated with it. Macro conditions can change over the life of that loan. And so, part of it is not just being able to use technology to streamline the underwriting or the origination of the transaction, but be able to see what data can I continue to get from the borrower in a seamless, painless way for them, because they don't want to deal with you after they have their loan and they're operating your business, to get early warning signs about, are there hits to their cash flow? Are they not billing as much as they should be? Have they, violated any covenants without, reporting to us and things like that? So, pulling in, bank account statements on a regular basis and tax returns, and being able to get that sort of stuff to do the monitoring has a lot to do with going out into sort of a more prime type product.
At RaiseWorks, we really look at the technology as being something that would improve both speed to offer and then offer to close. So I think technology allows us now in that offer to close, which is really the longest time period where you're gathering data, it's much, much faster than it used to be. And it doesn't require us to build all those pieces. Much of that's been built already by the ecosystem that exists. The same thing on the front end with the underwriting. I mean, there are existing business scores that drive a lot of what we do. So our approach is a little bit different than some of the others, where we don't have a physical underwriter looking at the files. There might be a fraud check or a landlord check at the back end, but it's math driven based on existing scores that have been proven to work over a decade or longer, much longer than we've been around. So by using that existing technology, we can move the speed to offer, which is the easier part, to be very quick, but the offer to close is where you're going to lose the borrower, where the borrower is going to disappear and go elsewhere, and where you're going to have the most improvement in your customer acquisition cost, which of course, if you're looking at drivers of profitability, the ability to acquire a customer at a reasonable cost per unit is the entire reason you're going to either be successful or fail, not the cost of capital.
Well, I guess, if you're using, so I think there's some truth to that around cost of acquisition, certainly, but if you're using all existing technologies, then I think there's some sense that maybe you'll get existing results. So part of the challenge here, and part of why the market hasn't been tackled in billions yet, is that amassing the data set as how this new sort of tweener market performs, right? It's not, deep subprime, it's not bank prime, how does it look in the middle? That requires some different models, I think, over time, where you can certainly start with what exists today, but to really refine the delivery of the product, it takes its own.
If you look at 10 years of data on, call it 20 million small businesses, you could look at even in the worst of the cycle, you had high single-digit loss rates, and if you look at most of that time period, small business credit losses on a 2-year basis are like 1.5% to 3%. So the data is already there that says the loss rates work. The banks may not be participating in it, but that's not because of the losses. That's because of capital and other reasons we're seeing that are systemic. But I think the data already proves that small business lending has a relatively low risk profile if you have a statistical based approach and doesn't require necessarily that human touch.
I'm not sure. I think when we started the company, we also bootstrapped our lending operations with outside data sources and other data sources. But until you've built really your own performance track record on your own loans, I think it's hard to make a value judgment on where technology is helpful, where it isn't. So when OnDeck started, very much like Funding Circle, we had underwriters looking at every single loan. And now, with tens of thousands of loans under our belt, we went back and said, okay, where did the underwriters add value and where did they not? And we built a statistical model around that. And so now 70% of the underwriting decisions don't touch a person, but 30%, right. But 30% larger loans, riskier loans where the fraud check type algorithms detect something odd, we think the underwriters still add value. So I think, I would say technology and speed are really, really important, especially for the smaller loans. If someone needs $500,000 in 10 minutes, they're a really bad planner. Right. You probably don't necessarily want to be giving that person that loan. But the flip side of it is we also think that people still add value to the process, not only, frankly, on the underwriting side, but also on the sales and service side. Right. Because a lot of what small business owners value is having someone to talk to, because these are big decisions for their business. They are making major investments. These are large loans. It's not like buying a toaster online. And they do want to talk to people at parts of that sales process.
So do any of you think that within a few years you'll be fully automated with no judgmental or human servicing?
For certain types of transactions, certainly.
I think the customer wants it, we can deliver it. I think the question is, many customers want someone to talk to at some point in this transaction.
I think it's a function of the marketing channel. If a customer wants to come to you through a call center because they want to talk to somebody, that's how you're going to start to input the information. But that's very different than needing that person to actually make the decision of doing the loan or to gather the data. And since most of the data and documents can now be grabbed electronically, that can be relatively self-serve. The same thing with that front end. You could go to the website, and if somebody chooses to go to a website and fills it all in, you don't need a person.
Tom, I wanted to touch on something Renaud said this morning when he talked about Lending Club seeing transparency is key to the organization and to its mission. And following up on that, to what extent do you believe that price transparency is an issue in the sector, and what is Lending Club doing about it?
Yeah, so transparency is a critical part of our company values. It's very important to us, both on the investor side, where we publish all of the details of all the loans that have ever gone through our platform, and on the borrower side, where irrespective of product, we have a resolute commitment to transparency. When you look at the small business lending landscape, I think there are quite a few options out there that are not fully transparent. A small business owner is not a finance specialist, probably doesn't know how to calculate an IRR in general, wants to get their financing done and move on with the real work of running their business. And so it's important for every industry player to provide complete transparency to their borrowers as to what the cost of capital is. Let me give you an example. In the merchant cash advance space, you see folks who are lending to borrowers at a 25% or a 30% advance rate. So they're lending $100,000 and the borrower is paying back $125,000 or $130,000. And then what they have to pay back is 10% of their monthly credit card receivables until they've paid back that $130,000. We've had small business owners call us up and we've offered them, let's say, a 14.9% interest rate. And they tell us, well, I'm only paying a 10% rate with my merchant cash advance. The level of sophistication sometimes is not that high, and it's not a criticism of small business owners. They're awesome at what they do, but financing is not their core business. And so it's really important to, and obviously that 10% of receivables is completely unrelated to the APR the customer is paying. They're probably paying 100% plus APR on that loan or that advance. So what we do is we make sure that for every borrower, we make it completely clear exactly what the cost of borrowing is going to be, how that's going to vary if they choose a different term, what their monthly payment is going to be, and just give them the absolute complete choice so they know exactly what they're getting into. One thing we do on top of that is we charge interest on our loans rather than charging all of the interest up front or all of the cost of capital up front, which means that if you pay off the loan early, you actually reduce your total cost of capital and save money.
To piggyback on that really quickly, I think transparency and service being one of the points we were just talking about, are two of the things that are most important in terms of creating a really good approach for finding the highest quality borrowers and making sure the capital is priced quickly. I can speak to this as a small business owner myself, which is actually kind of how I got into this. I spent a bunch of time working on Wall Street, had built another financial technology company, and then along with my co-founder had opened a set of gyms. Really profitable, lots of assets, lots of cash flow, talked to 90 different lenders. One, had a heck of a time getting a loan, but two, most of them couldn't even produce an amortization schedule, let alone an actual calculation of what the APR is. Most people, particularly the smaller ticket lenders, quote in terms of a monthly payment. And if you're a small business owner, you're sitting there, you're getting a flood of direct mail with all sorts of crazy propositions being thrown at you. It's just very, very confusing. And so at Funding Circle, one of the things that we try most to do is to make sure that a small business owner really understands what they're getting. We are extremely transparent around our fee and also what the monthly payment is and the interest rate associated with their payment will be. And part of what we do in the underwriting process, and this is the customer service point that I think Noah is speaking to, is make sure the small business owner knows what that means and feels very confident that they can pay the loan back.
Yeah, I think part of that is speaking the borrower's language. So certainly the traditional alternatives have been, equipment lessors and merchant cash advance and factoring, and so they have, they've been quoting on factor rates or buy rates for a long time. That's what a lot of these businesses have seen, and so part of it is, well, at DealStruck we always quote on an APR basis, but we provide a lot of tools and education and calculators and say, well, if you need to know how this compares to something that was priced for you on a buy rate, we'll talk to you in that language. If you need to know how it compares to what you would have paid, on a factoring transaction, we can compare to that. So it's not just about, saying it how we want to say it because we think about interest rates. It's about making sure that the borrower knows how it compares to their alternatives, and a lot of that has to do with giving them real examples, giving them the tools that they need in the education to understand how these alternatives are different from the typical lenders who have been in the alternative space.
I think there's two big parts of that short-term lending where the transparency really was, there's issues that I think term lending can help solve. I think one is there's typically an upfront brokerage cost or third-party cost, which tends to not be present in the term loans. And secondly, you have the cost, or what I'd call the frequent turn or churn, because if the loan is short-term and you have to re-up those upfront costs every time, the loan becomes very expensive. That's very hard to equate into sort of APR terms. Where in a 2 to 4 year loan with some upfront cost, that upfront cost is being amortized, ratably over the life of the loan. It's easier to explain to the consumer what the true cost is, and that true cost, of course, is what's important.
Go ahead, Noah.
No, I was just going to mention the point that Ethan made about translating the cost, I think, into several different metrics is super important, because a lot of business owners make this decision on the total interest cost they're paying. So a lot of the APR-based disclosures have a monthly payment and they have the APR, but they don't actually say, and you're going to pay X thousand dollars in interest over the life of this loan. And typically we see borrowers really bifurcate into a couple different categories. Some of them are optimizing for loan amount. Right? If you can't give me $60,000, I have a project that takes $60,000, I'm not interested in taking this product. We have other folks who optimize for APR, what I would say, and monthly payment or daily payment or whatever it is. You know, how can I push this term out as much as I can to reduce the burden this loan makes in my business? But there is a third class, and we see this all the time, who are optimizing for the total dollars paid to the lender in interest. So if you know you have an inventory turn in your business that you need financing for, and you're going to turn that inventory in 6 months, you're very conscious of that. And so you might actually choose a higher APR, lower dollar cost option, even if you had multiple options on the table. So we want to let borrowers sort of choose between the thing that makes sense for them, and to Ethan's point, you have to translate it into those terms.
Yeah, I mean, and part of that is sometimes putting multiple offers out there, right? So sometimes the borrower isn't sure what they're optimizing for until they see, well, I could get $150,000 on these terms, I could get $75,000 on these terms. You know, how do those play into my calculus around what's important to me? And a lot of times, until they see those, they don't really know what's important to them.
But surely you do have to compare apples to apples. If you have, you know, one looking at the total amount over a term of the loan and another looking at an interest rate, there's some transparency, which means putting those offers next to each other. It's
apples to apples. It's how they perceive it, right? So it's when they see a monthly payment that's $2,200 versus a total interest cost that's $26,000. Those mean different things to them, and it may trigger, you know, different decisions. And at the end of the day, they need to make the best decision for their business.
So very quickly, other than transparency, what are you doing for small businesses in terms of impact? And if you believe there is a positive economic development impact in the work that you do, how do you measure that?
This is huge for small businesses. If small businesses have delivered 2/3, 66% of all of the job creation in the US since the 1970s. And so anything that any of us can do to capitalize small businesses better, to help them to grow, is going to be good for them, their families, the economy in general, the communities in which they're based, where they employ people. All of that, I think, is fantastic for so many different people, and so, you know, that's just, you know, an enormous impact. And so every small business we can lend to helps us to deliver value to all of those people, and of course to us and our investors as well. But it's just great that it has these multiple benefits for multiple parties.
Just to add to that quickly, you know, sort of a macro point and a micro point. On the macro side, after crossing over the $1 billion mark, we actually commissioned an outside firm to go and survey our business owners and try and actually do a quantitative assessment of the economic impact. We'll have those major results out in a couple weeks when we more formally release the survey, but informally, you know, we believe that the $1 billion of on-deck loans has created 22,000 jobs in the economy. For every dollar on-deck's put out in the economy, about $3.50 of economic output has been generated. So on a macro basis, you know, these are real catalysts for the economy. And on a micro basis, I think because we are providing capital to many businesses that haven't been able to get it from banks before, one of the most important things we do is we report on-deck loan performance back to the business credit bureaus. So as a business takes more loans over their life with on-deck, they build up that track record with the business credit bureaus, because it's a very different world than personal credit. Personal credit has almost universal coverage. Business credit is much more opaque. And by building that up for the business owner, they then get a lot of opportunities later on to go back to banks, to go to the SBA, to get trade credit, which is really important as they build their business over time.
Great. Sorry to cut you off. I just want to make sure we have enough time here for questions. And very quickly, if you could just mention, you know, what's the opportunity for investors today, and where you think there will be new opportunities within the next 12 months? And you just do it very briefly. I'd appreciate that.
I think the business loan market is quite different than the consumer market, which predates it a little bit. I think it's a whole loan market, so I think the action for investors will really be in the securitization world, either whole loans that eventually get converted to securities, or portfolios that where derivative securities are created. I don't believe it's the same opportunity for sort of the mom and pop investor to directly invest in a business loan. I don't think that's the case today, and I don't see that being the case in the future.
I would just say that early markets in any capital market product are very inefficient, and so as an investor, when you look at a number of platforms that are still in their early stages and some lenders that are a little bit beyond, but it's still an early market, this is a time where there's going to be excess margin, so to speak, before the rest of the world wakes up and sees that risk adjusted, this is a great place to be and it's doing a good thing. So the next 12 months, now's a good time to get involved.
For us, for investors, we believe that we're the only platform, and I'm not totally sure of this, I don't want to overstate it, but where you can play at both a senior level, a sub level, or take the equity risk of the loan. So we did the public securitization last week. There's an A note and a B note there with kind of different terms associated with them, and that's all out there in the record. And then we also have OnDeck Marketplace, which is a means for investors to buy whole loans on our platform, and actually take the equity risk, so to speak, of those loans. So we think there's multiple appetites out there. You have an insurance company who wants a lower coupon, but also very, very low default risk and that kind of structured product. And then you've got more aggressive, let's say, hedge funds and other types of investors who want some of the volatility in exchange for getting more return.
We've had a lot of interest in the asset class. For products that are new for our company, we work with sophisticated institutional investors who understand the risks of investing in a relatively new product. So that's what we're doing. Once we've developed a good track record, we do plan to open up the small business loans onto our retail platform and allow individual retail investors to invest in these loans as well.
And for Funding Circle's part, it's interesting because the US and the UK have kind of evolved to overlap. In the UK, we started with primarily a retail fractional product. The US, it started primarily as an institutional whole loan product. And actually, by the end of the summer, we'll, in both geographies, have the ability for people to go in and purchase whole loans, which they can do today in both the US and the UK. We'll have the ability for people to go in and invest through a managed fund product, so they can get access to the type of assets in a diversified way immediately through the platform, and also the ability to go in and pick and choose pieces of loans or have an automatic allocation for the types of loans that they want exposure to.
Great, thank you. So we'd love to take some questions from the audience. Please, if you can wait for the microphone. Anyone else while we're...
Stuart Stein from Moneyplace in Australia. A really interesting discussion, guys. You talked a lot about educating borrowers. What are you doing, just continuing that last loop then, about educating investors about really understanding the credit risk and the underlying sort of risk that's inherent to small business lending, which is very different to consumer lending?
Sure, I guess I can speak to that first. In the UK, we have a loan book that goes back now, going on 5 years. And when investors come in and want to pull in a lot of information so they can do detailed analysis on a vintage by vintage basis, we can provision that. In the US, our loan book is a little bit less mature. Our oldest loans are now about 2.5 years old. And here, we have all of the historical loan performance. We also have a bunch of third-party data that we've gathered that will be indicative around how loans should perform. So I guess particularly around the whole loan marketplace, which primarily is institutional, we basically just have a really detailed diligence pack that people can sift through and understand what the kind of the box of expected outcomes will be.
Great. I'd like to take another question back here.
Hey, my name is Evan Baer with Able Lending, and we're working on an underwriting model trying to ingest social media and social graph data of the founders and the businesses. I'm curious if any of you guys are working on incorporating non-traditional data sources into your underwriting model so that you can offer more loans to businesses who don't make it through traditional underwriting.
Yeah, I mean, I can speak to that. We absolutely have. And I think the important thing to remember about social data is exactly what you said. There's a business that has a social data profile. There's a consumer that is the owner of that business that has its own social data profile. And there are credit signals in both sets of data. So I think it's fertile ground for exploration. But one thing that I want people to understand from an investment standpoint is OnDeck doesn't make loans depending on whether someone liked the chicken they had, last night at a restaurant. It's very, very noisy. And you have to be careful of that, I would say, in incorporating this type of data. But it is an opportunity for innovation.
I mean, a lot of that stuff is proxy. So if you can get to the source, it's like proxy for cash flow or proxy for personal credit. And if you can get to the same data just as quickly and seamlessly and painlessly, then we would prefer to do that. But there's some validity to it, perhaps.
And I would just to quickly say, I would reject the comparison between traditional lending and lending that uses social media. There are a large number of data sources that are out there, some of which we're using, which are not social data sources, but which are modern and which none of the banks are using.
Great, thank you. I think we have another question.
Hi, my name is Harsh. I'm studying at the Stanford Business School right now. Some of you mentioned that some of the small businesses are not the most sophisticated in their accounting systems and so on. So I was wondering if you could talk about how your technology kind of parses their data that they're uploading, maybe errors in them, and just kind of bypass the human and just kind of do it in technology.
Sure. So I guess I can speak for Funding Circle first. We try to make the borrower experience as simple as possible. And we ask them to self-report on many areas. We also ask them to link accounts. We also go out and gather information on them based on a variety of third-party data sources, including a lot of alternative data, some social data in there. And where possible, we'll use third-party data to either validate what a borrower says or to actually provide an independent input, really keeping what they have to provide for us as simple as possible and removing as much potential fraud as we possibly can.
I mean, we wouldn't ask a borrower for something that we don't think it's reasonable to expect them to be able to provide. So we're not going to ask them for their quick ratio because they may not be calculating that on a regular basis. We're going to ask them for data that enables us to identify their business and gives us a few key facts, and then we're pulling in as much data ourselves as we can in order to make the best decision.
Great. Well, I think that's it for today, and I wanted to thank our panelists again for a fantastic discussion. Really appreciate you guys coming up here and doing all this.